Welcome to another episode of Capital Spotlight. Today we have Michael Atkins from Cormorant Capital. Thanks for coming on the show.
Hey, Rob. Glad to be here.
Absolutely appreciate it. So to start off, just give us a little background on Cormorant, what you guys do in the commercial real estate space.
Yeah, so we look for middle market value add and opportunistic deals, sponsors that need equity. We look to help them grow their businesses by providing that equity from the range of capital sources, family office, funds, private equity, sovereign wealth funds, sort of the spectrum of capital out there. And we also advise CrowdStreet, which is another big player in the capital raising space these days, the online capital formation space. So that's been a great partnership. That's the opportunities we sort of saw were very interesting in the middle market space, and that's why we pursued it.
Very interesting. Yeah, some interesting stuff there, especially about CrowdStreet. So we'll dive into that in a sec. But before, I wanted to just let everybody get a better understanding. What type of deal size, check size do you guys specialize in? Because you mentioned family office, you also mentioned sovereign wealth fund. So it sounds like you guys would go from a pretty small potentially to very large check.
Yeah. So in terms of raising outside equity, it's typically, I would say, 2 million to 20 million is a good sweet spot. And we've also invested in syndicated deals at the GP level that are below 2 million. So, we like to look for opportunities that are interesting, essentially. And if the check size is too large, then we'll bring in, another group that can help fill that out. But fundamentally, we look for deals that we get excited about and that we want to be in ourselves.
Yeah, so let's talk about that more because that is unique in terms of being an advisory as well as a principal investor. So talk about what your approach looks like in terms of when it's the right time to invest, Cormorant's capital, or when it's, just an advisory deal, and how you align interests and make it, successful for everybody.
Yeah, right. So, first of all, we look at every deal, not just from what amount of capital is needed, but what are the right alignments. We like to bring in partners that fulfill really the multiple goals of the sponsor, not just writing a check, but also in terms of structure, in terms of, what makes sense in terms of the philosophy on business plan and exit, and also what kind of programmatic potential is there. So, for us, I'd say anything up to $1 million, we're happy to look at participating, I guess on the investment side, and anything above that, we'll bring in additional parties to help fill that out, depending on what's needed and what the best, set of alignments are in place.
Got it. So it sounds like an ideal deal, assuming it checks all your boxes, might look like a sponsor who's going after a pretty large size deal and in need of both LP and GP capital. You can arrange the LP and then come in on the GP side alongside the sponsor to help fulfill that requirement and hopefully pick up some more favorable economics for yourself as well.
Right. And, what I would say with that is we're less focused on maximizing economics on a deal by deal basis and really more focused on maximizing the relationship. That's really critical to us. Commercial real estate business, as much as we all use, various tech types of platforms, at the end of the day, the best things get done based on relationship, and we're very focused on that piece of it.
Definitely makes sense. So let's talk specifically then. What would it look like economically? Are you going to do a discounted fee structure to arrange the LP in exchange for coming in on the GP? Or are you just going to pick up, some promote?
We're not really, I would say, fee focused. We're motivated by, aligning our interests as well with the sponsors. So we, really look to, come in for sweat equity and alongside writing a check as well with the sponsor. That's to us the best structure. It's also optimal when we're approaching investors because, they know that we're not doing this just for fees. We're doing this in order to get investment exposure for ourselves. And so it also aligns our interests with the investors that we're bringing in.
Yeah, I think that's a really powerful component. I mean, makes your job on the advisory side a whole lot easier.
Absolutely.
So let's go back to that when you mentioned about CrowdStreet. Share what you can about how you're, acting as an advisor or being value added to their pursuit of, online capital formation.
Sure. So the interesting thing about CrowdStreet is, this company got sort of up and running around 6 years ago. And it was really around the same time when you saw an explosion in the number of these companies. I think there was probably 150 or 200 focused on the real estate space, in the early days. And every time we saw a new firm get launched, wanted to give them a call and find out what they're doing. It was very interesting. I think it was a mix of kind of seeing where the opportunities were and really just, FOMO. We don't raise equity from, high net worth or accredited investors. That's really not our business. And so this was kind of an avenue to, achieve the economics and structure, advantages that you have with high net worth individuals in a more systematic and institutional sort of way. And so we would call up a lot of these groups and sort of say, hey, what's your business? What do you guys do? This is interesting to us. How can we work together? And so I got introduced to the founder of CrowdStreet, Aaron Powderly, at an Urban Lands Institute event a few years ago when he was just getting started. It was basically, Darren and his laptop. And, we really saw eye to eye on the opportunity in the middle market space. All these great sponsors out there who were sourcing deals that, really were, interesting to high net worth investors. In a lot of cases, they already had a set of high net worth investors that they were syndicating deals to, but wanted to grow that. And so CrowdStreet kind of grew alongside these groups and has since, raised pretty substantial amounts of capital, even recently, and has very impressively built their business. It's run by great people. It's been, very, it's been a very stable and really they focus on learning and improving the process along the way. So I have a lot of respect for them as a company, and they've grown very well and brought on some good partners at the company level. And it's exciting to sort of see them navigate these choppy waters and do such a tremendous job. And so I'm excited about where, that business will be, in the future.
Yeah, it's definitely been a big growing opportunity in terms of the accredited investor space and ways that can help, fill out the capital stack and make deals work, which otherwise, would be either overlooked or just not being able to get done. So definitely an important part of the space. Jumping around a bit, just going back to Cormorant's principal investing, where does that balance sheet come from? Is that being sourced from, a close group of private investors, or is that, potentially maybe eventually you guys will create a syndication business and, create a syndicated pool of equity to put out that capital?
I've thought about that. I don't think at this point that's really the goal. It's internal capital that we have the luxury of really just doing deals, looking at deals on a deal by deal basis. And choosing what we want to work on. I don't think it in itself, it will become an investment business. I think we'll maintain the advisory sort of component. It just works so well. It's not to say we don't look for ways to grow and ways to evolve, but, over the past few years, that's been defined more in terms of sponsor selection and understanding deals and really just getting better and better at, formulating the best structures for groups in the most efficient way possible. And really at the end of the day, it's building that expertise that, is our differentiator, just in the same way we, tell our sponsors time time and time again that, the geographic or product specificity that they build within their platform is a major differentiator in the market, and that's what investors look for. For us, being good at that narrow piece of the business, getting better at it, has served us well.
Yeah, it's so true about, the first thing a potential investor is going to ask is, if you're bringing them a deal, they'll say, well, do you already own and operate in this market? What is your expertise? Because they want to lean on a local expert, rather than take a flyer in a new market with a new operator, for sure.
Yeah, you got it. I mean, think about it. 40 years ago, somebody said, hey, there's going to be multi-billion dollar, in many cases, many multi-billion dollar publicly traded companies that rent storage space. You'd be like, what are you talking about? You're a lunatic. But that's what we have today. The real estate has become a business of specialization, and over time, that specialization, it's both geographic and product specific. And I think that's really the philosophy that underpins how we look at things. In other words, what is it that our sponsor knows, geographically or product wise, that gives them an advantage to spot inefficiencies in the market, whether it's in the current, sort of rental income, or if the property is not highest and best use, or if there's some other strategy that can be undertaken to add value, asset level, so you can generate a return without having to make a bunch of market or macro assumptions. That's critical these days, because anybody can go on a broker website and buy a deal, but understanding how to monetize it in a way that is superior, to the other guys out there, that's the special sauce.
Absolutely. So staying on this topic, let's go more into advice to operators looking to position themselves to improve their ability to attract capital. So as far as we already talked about to and location and strategy, asset class, what are some other things that operators can do to maximize that?
So, real estate is a very legacy kind of business. So I think, if you're building a business, and your business is probably a good example of that, based on the vintage. If you're building a business that isn't encumbered by old processes and isn't encumbered by the offline old way of doing things, if you can, step out there and embrace, tech-enabled ways of doing business, really with a lot of off-the-shelf kind of technology, and just be smarter about how to use it, that's something that distinguishes a lot of groups that we see out there. If you can combine that with, tying that back into just old-fashioned geographic or product knowledge, those things, I think, in itself are already going to put you head and shoulders above the competition, especially if you can, source the deal in an interesting way as well,
Right. Unique sourcing, I'd say, is probably one of the harder ways to differentiate yourself, just because so many deals are on the market, and even deals that are off market are still being, to some extent, shopped. So really creating a differentiated deal flow, I think, is potentially one of the most challenging but most rewarding way to, create alpha or outsized value.
Yeah, 100%. We really view it as an important leg in a three-legged stool, which is, a quasi or proprietary way of deal sourcing, a skill set that in itself is created a barrier, because there's unique ways that it can be used to monetize, assets, and access to capital. And so you have any two of those legs, the third leg, follows. And that's another kind of underlying, philosophical approach that we take to our business, and how we look at, again, creating the best alignments between sponsors, the right sponsors, and equity.
Yeah. So you said some good things there for sure. One thing that is certainly a recurring theme, and for good reason, is the idea of value creation, and that people don't want to invest in, a market rate transaction and, not get some sort of above and beyond value creation. So my question is, what's your experience and how do you solve for core and core plus capital? How do you attract capital to, really deals that don't have some sort of lift or compelling business plan to it? And it's more so just hey, we like the market, we like the asset, and we're gonna, we're comfortable with the level of coupon. How do you attract that capital?
I think you got to find a way to differentiate. So, if, you're looking at a core plus deal, there has to be something that institutional capital, there has to be a reason why institutional capital is not chasing it. Maybe it's not a core plus location. And, the very definition of core plus location could be changing, certainly in the short term, maybe permanently, given everything that's going on in the market. So, there has to be something that is, not traditional or conventional in the core plus sense. Maybe it's the size of the deal, something that gives a smaller operator advantage, maybe a smaller deal over the larger institutional capital, which has access to lower cost of capital. So, if you're, buying maybe a new build asset that's not in a, traditional core location, and you have high net worth investors who don't otherwise have access to real estate investment, and they want something that is, feasible for them in terms of check size, but safe in terms of strategy and minimization of, for example, capital expenditures in the near term. That's probably one way to approach it. And that's, guys are doing that. They're definitely rotating into higher quality assets like that may not have been defined as core previously, either because of the size or the location.
Right. So still trying to achieve higher returns in the fringe of the core plus, with either being in, smaller markets or smaller assets or something like that.
Yeah. Or just making sure that, what you're paying, at the end of the day, we all pay for the value is a function of what we pay for yield, and, that's how we figure out what to pay for something. And so if you have a high degree of comfort that yield is stable, and the investors, want to achieve stability, in their income stream rather than, a lot of upside, that has a value as well. That has an investment value to your investors. So, it's all about also the investors that you do have access to, how do they perceive value, and how do you lead them to that perception and value? In a lot of ways, they're looking to us, if they're not real estate investors, they're looking to us in the real estate world to help guide them to, what is good value in real estate in terms of what they're trying to, achieve with their investment objectives.
Yeah. So, we'll stick to one more question on the core plus, which is just what would, a deal, if I brought you a deal, what would it be? What would it look like for it to really make sense as a core plus deal? What's the yield level, kind of general characteristics about the location, the asset type? I know, especially on the core plus side, investors are very vintage conscious, right? And they don't really love even a 1980s deal if it's a core plus strategy. Value add, they can get comfortable with, 70s, 80s, but core plus, things get more particular. So what does that look like?
Yeah, it's interesting on the vintage. Absolutely, investors and lenders are looking to rotate out of older vintage into newer vintage. And I was listening to Mohammed El-Larian on Bloomberg the other day, and he was sort of pushing the same thing, rotate into higher value assets. And you see it in the real estate world as well. So I think, one way that people are looking at doing that, we have a lot of newer build construction where the sponsorship or the developer, may have spent too much to build the building relative to the whatever yield it can achieve in the short term. Some developers and their investors have the ability to hold out, others don't. So one way to think about, getting access to core quality assets is to recap, new build deals where the lease up, has been slower, and it's creating a drag on the equity and debt capital stack. And so You could get creative with recapping the deal with new equity, with preferred equity, or just buying it at a discount to stabilized yield, and sort of taking that lease up risk and making a bet on how long it'll take you to lease it up and what rates you can do that. I don't think anyone is underwriting a lot of rent growth anywhere at this point, at least at the macro level. And so, so those underwriting assumptions will undoubtedly cause some, significant headwinds with investors or with existing developers in their deals. We just haven't seen it yet.
Yeah. And I think that's one of the spaces that has me very excited, which are the, new construction deals that are in lease up and having troubles and potentially liquidity issues. And like you said, might be able to buy it at a discount, take on that lease up risk. And then eventually you own a stabilized new construction property at a great basis. I think, if we do see something like that widespread, those will be some great opportunities.
There's absolutely capital available in looking at those kind of strategies when and if they arise. And at the end of the day, it's a matter of, it's a market. So it's a matter of supply and demand. And it's a question of, how many of those opportunities hit at once, that will determine the scale and sort of breadth of the demand of the, potential to do those deals.
Yeah. And that's actually a really good point. I think a lot of people miss that when they talk about distress and opportunistic investments, because if you just have one-off, idiosyncratic examples of a failed lease up, for example, that's going to get gobbled up by the market and someone will pay retail price for that just because there just isn't a widespread opportunity. But if we see, in every pocket failed lease up deals that can be sold at a discount, that will result in them being sold at a discount, right? So I think that supply and demand is a big point that not a lot of people talk about, because everybody says, oh, well, the sky is falling and I'm going to be able to buy hotels or retail or multifamily at a steep discount. And, that may or may not be true, but I don't think they're factoring in the supply and demand part of that equation.
Yeah, at the end of the day, the Fed could be crowding us all out and be doing those deals.
Exactly. Yeah, that's what we've been pretty much seeing so far. And going back to your point about rent growth, so far I've seen, among other things, really stifle transaction volume, right? Since buyers are scared to underwrite rent growth, at least in the near term, sellers are still hanging on to yesterday's pricing, and that's just creating a bid-ask spread that is untenable in most circumstances.
100%. So what's happening is, you're also you have the additional, market component of the debt guys saying, hey, we want you to put in a little more equity to do this deal and maybe give us a little bit of recourse. Well, that becomes dilutive to the equity returns. And unless the cost of equity goes down substantially, then, the impact in the underwriting is on what people are willing to pay for an asset. And so until now, people have been able to get deals done through structure, maybe additional escrow to essentially act as an insurance policy for the non-payment of rent, as a alternative to adjusting the purchase price. But it remains to be seen. That was sort of a Band-Aid to get deals done. In the future, it's hard to imagine that not affecting the purchase price even in a zero rate environment for the foreseeable future.
Yeah, that's interesting. The debt side is certainly moving the market, and it always has, just because people are solving for levered returns. And an interesting point you brought up is, while the cost of debt has gone down, right? We've seen, LIBOR go down to almost zero, 10-year has gone down. So, the cost of debt has gone down, but also if lenders are requiring more equity, that's in the end going to be, as you said, dilutive to the returns, even though the cost of debt's going up just because equity is more expensive. And if more of your capital stack's coming from equity, that's obviously going to hamper valuation. So I want to ask an interesting question, which I think in terms of, discounted cash flow valuations for, the public markets, for example, it's pretty well understood that there's an ideal mix, in terms of debt and equity, and it's your job to find that ideal mix, which can have to do with taxation, and it can have to do with the cost of debt, cost of equity, and how more leverage you put on it increases the cost of equity. But on the real estate side, most of the time people are just seeking as much leverage as they can get, right? Basically, whatever the lender's willing to underwrite to, that's the appropriate amount of leverage, and that's what they'll take. So from your perspective, do you agree with that, or is there a more nuanced approach that you guys take in terms of evaluating the pros and cons of max leverage, essentially?
Yeah, I think you're right. In terms of saying it's a very situation specific, analysis. It's funny though. I've had a couple conversations in the last week where the sponsor has been presented with options that are too much leverage. It's like the terms are too good. And they just don't feel comfortable with the amount of leverage, regardless of the cost that's being provided. And so, I think you have to look at what's your ultimate exit here. If it's a refinance and you have signed a new lease in an office property, for example, what happens when that lease, term, when you near the end of the lease term, and you've got this great debt on the property, is that going to hamper a refinance or a sale? I think that's, those are the things to look at, how, not only what are you trying to solve for today, but, what's the ultimate strategy with the asset? What's your optionality, at term, and how is that affected by the debt that you're trying to put on the property? So it's kind of a funny dynamic these days. You've got debt that's available, but at the end of the day, you as the operator should be better at underwriting the ultimate strategy on the asset, and the debt has to align with that.
Absolutely makes sense. And I think a classic example that you were alluding to there was longer term debt with yield maintenance, and how that may affect the future desirability of a refinance or a sale. And that's kind of cliche at this point. A lot of people talk about it, a lot of people bring it up, but the attractiveness of yield maintenance paper is often difficult to turn away, and you take on those onerous terms in exchange for what could be better leverage, better pricing. So some things that we have to live with. But I also think if you are really solving for your exit, you may take a better look at floating rate debt, or paying up for a declining prepay, or even if you're really confident in your business plan, a bridge loan.
Right. On the other hand, banks may end up owning a lot of assets in the next year or so, and maybe you should take that while you can get it, while the lenders are still lenders rather than equity owners.
Right. Yeah. I mean, while the capital markets window is open, certainly.
Absolutely.
So I want to jump over to something that's definitely less talked about, at least, less familiar to me, but very interesting nonetheless, which is on the, the corporate level investments as well as M&A. So to start, talk about your experience with, entity level investments in real estate companies directly.
So it's an interesting sort of space to play in. And, whereas the investable universe in value-add real estate is practically infinite, finding the right entity level investments that make sense, and that, where the objectives of both parties align, it's a lot more challenging than finding, sort of value-add real estate deals. There's just a lot less. So, I think it comes down to a lot of times, things that are much more, sort of personal to the ownership of a company. You could have founders who have built a great business, and whose succession plan may not be clear cut, or maybe there is no succession plan. And so, those are oftentimes challenging conversations for people to come to terms with, with themselves as much as anyone else. So, that's kind of one bucket. And then, valuing the various promotes, and valuing what would be considered the assets and the fee streams over time, is in some ways similar, in some ways different than looking at, real estate. The other thing is, there are opportunities where providing new capital for a new strategy is a way to grow the business because it creates more vertical integration or sort of synergies among product types, for example, that a company is going after. Maybe there's some common denominators that help on the cost side, that help them produce more on the cost side at less, for example, if they can, source better materials or streamline back office, all of those typical kind of M&A things. If you can add capital and a capital partner, at the end of the day, it's not just the capital, it's who's the partner and how can they help grow the business strategically. That's another kind of, I would say, subset of opportunity in that, for that strategy.
So what does a real estate company look like, the one that is interested in having some sort of transaction occur at the end of the level, whether they're, I guess, selling promote interests or selling how does that, why do they want to do that basically?
Well, the best reason to do it is to, maximize your investment and your equity, right? From that perspective. From the investor's perspective, the best reason to do that, is, there's a strategic reason to help, grow that further, So that's where the challenge begins in terms of aligning those interests and making sure that, if whatever the objectives of the owner are, align well with the objectives of the investor in order to get to, a point where, you've augmented those cash flows. You want to increase those cash flows and get rid of inefficiencies in the same way as if you're buying a value add multi-deal and, improving the management structure so you can increase rent collections or, enhance the apartments and therefore enhance the rent, the rental income. It's the same kind of concept that would be applied to, an M&A piece, which, again, there's a lot less of those out there, but it's the same underlying sort of concept of value that drives it.
Right. Absolutely. And so, in terms of value, what if I'm an investor looking to make one of these investments? Am I a financial investor or am I a strategic investor? And what are the returns typically that I would be seeking?
For an M&A type of deal?
Yeah.
So, I would say opportunistic in terms of how we in the real estate investment world look at deals. So you're looking at opportunistic returns. In the private equity M&A world, that's what's required. Real estate's a lot more boring in a lot of ways compared to these high octane private equity guys. It really has to kind of match that. And that's often the challenge. But it could also be that a company that's very strong in a certain product or geography wants to grow into another geography and can just do things better and cheaper and has access to cheaper insurance, for example, or lower cost of debt. So you can come in and immediately with a balance sheet or direct insurer relationships. Those costs have gotten very expensive, obviously. Come in and streamline the business and free whoever is good at what they do in that business to do more of what they're good at.
Right. So yeah. And then on more of the M&A side, in terms of operators acquiring management companies, talk about a few past assignments that, would highlight what that looks like and what the benefits are for an operator to go out there and buy a management company.
Honestly, that is something that makes a lot of sense, but we haven't necessarily seen a lot of that, in part because the cost to acquire the management company has been really prohibitive. Operators have decided that it's cheaper to build than buy. It's the same kind of analysis. You look at replacement costs in an asset. Well, what's the replacement cost of building this ourselves? And some have even said, our investors don't care about vertical integration. They care about, asset management. That's what they pay us for. So hire the best in class operator, or hire the best in class manager. That's fine. So it's interesting, the diversity of opinion within that. And again, ultimately it comes down to very situation specific, type of things. Who's good at what and where.
Yeah, interesting. My guess is, and from what I've seen, it's more common to see, larger scale buyouts of vertically integrated companies themselves. So an operator would go out there and buy, a shop that already has the ownership of the entity of the properties as well as the management, and then they can go in there and take on, and they're coming into an infrastructure, right? So not only are they getting a nice size portfolio of, let's say, $1 billion, $2 billion, and hopefully a concentrated geography, but they're also assuming an infrastructure of property management that they can hopefully fold into their operations. Is that
Yeah.
accurate?
Yeah. If your economics in that structure are superior to the, build it yourself, and you throw in the sort of time value of money. Yeah, absolutely. You just haven't seen, I think what you have guys looking for now are management companies that are looking to bring on vendors and become more vertically integrated that way. We've had a couple management companies that have approached us for, the purposes of identifying vendors they can buy. So it's also achieving more vertical integration within that piece of the business itself.
Very interesting. Yeah, I haven't thought about that, but I definitely, have thought about the build versus buy in the management space. And, for us, we've gone the build it route, which I think, as you said, most people make that decision. They think they have some unique insights that they can then turn into a profitable business.
Are you finding access to personnel, which has been a huge impediment, any better these days in the build it, on the build it strategy? It just seems like the challenge for people on that side of the business has been, attracting and retaining talent.
100%. That's certainly. I mean, property management is a people business, all around, and it's definitely the biggest challenge and probably the key to success. And so, we've seen maybe it become a little bit easier with, coronavirus, and, we had a property management position become available, and, we were flooded with applications, so there's, opportunity there. But, because we recognize this as a challenge, we are taking the angle of virtual assistants. So trying to, create corporate level employees that can then help on-site employees function more productively. And we would utilize, out of country virtual assistants to, to really get that job done cost effectively.
I mean, I would consider that there's your tech, enabled off the shelf kind of thing you can do, and, tweak it for your business and arbitrage it. So yeah, that's great. Would you say the applications you got, were higher quality as well as volume? I mean, on one hand, it's hard to imagine 15% unemployment in the property management business, just given the challenges attracting talent before. But are you seeing quality as well as quantity there?
I don't know if I can say one way or the other. My hunch is that we're just seeing more quantity, right? Which in the end will allow you to sift through and find quality, but I don't think it's necessarily creating more quality on average.
I'll make sure and tell that to the guys you just hired.
Right.
Just kidding.
So yeah, I think that wraps it up for us. Again, really appreciate you having a great discussion here, and go ahead and let listeners know where they can find more about Cormorant Capital and connect with you further.
Yeah, well, let's you can blast out my email address, and happy to follow up with any questions. And thanks for the opportunity.
Sounds good. Yep, I will put your information in the show notes, and thanks again for coming on the show.
Thanks, Rob.